Right now, while most XRP holders are doom scrolling red candles and asking themselves why they ever believed this cycle would be different, something far more important is happening just beneath the surface, something almost nobody is talking about. XRP just touched levels we haven't seen since November of 2024. Bitcoin slammed into a 20-month low. Liquidations are stacking up by the hundreds of millions. And yet, in the middle of all that carnage, institutional money has been quietly walking through the front door for 7 straight weeks. Not retail, not influencers, actual regulated capital flowing into XRP ETFs while the price chart looks like it's falling off a cliff. That divergence, falling price, rising institutional appetite, is one of the most telling signals in this entire market right now. And if you don't understand why it's happening, you're going to misread everything that comes next. In the next few minutes, I'm going to walk you through exactly what's driving this sell-off, why the Clarity Act suddenly became a coin flip instead of a near certainty, what the whales are doing differently than the people panic selling on Telegram right now, and why the next 6 weeks could be the most important stretch for XRP since the SEC case actually ended. I'm not here to hype you up, and I'm not here to tell you we're doomed either. I'm here to walk through the evidence point by point and let you draw your own conclusion. So if you've been sitting there wondering whether this is the bottom, whether this is just noise, or whether something has actually changed about XRP's long-term thesis, stick with me, because part 1 is where we start pulling this apart. Let's start with where we actually are, because I think a lot of people watching this video are emotionally exhausted, and that exhaustion is clouding their ability to read the chart objectively. XRP has been grinding lower basically all through June. We went from trading in the 1.30s in the early part of the month down through 1.20, then $1.13. And now we're sitting in territory that, frankly, a lot of people didn't think we'd revisit levels not seen since late 2024. That's not a small pullback. That's a genuine repricing, and I think it's important that we don't sugarcoat that. If you bought XRP expecting a straight line up because of ETF approvals or because of the SEC case wrapping up, this chart has probably been humbling for you. And I want to be honest with you up front. There is no version of this video where I tell you this dump doesn't matter or that it's just noise to be ignored. It matters. Price action always matters because price is the one thing that aggregates every piece of information, every fear, every hope, every position, into a single number. So let's actually understand what's feeding into that number right now instead of pretending it isn't happening. The first piece of this puzzle is Bitcoin, and I think this is something a lot of XRP-focused channels underweight. XRP, for all the talk about it decoupling and having its own catalysts, still trades inside Bitcoin's gravitational field more than most of us would like to admit. When Bitcoin breaks down to a 20-month low, when you start seeing liquidation cascades in the hundreds of millions of dollars, that's not a localized event. That's deleveraging across the entire crypto complex. Leverage longs get wiped out, market makers pull bids, and altcoins like XRP, which generally carry higher beta than Bitcoin in both directions, get dragged down even harder. So when you see XRP losing key support zones one after another, the first question to ask isn't what's wrong with XRP specifically, it's what's happening to risk appetite across the entire asset class. And right now, the honest answer is that risk appetite has deteriorated meaningfully. ETF outflows on the Bitcoin side, a hawkish tone out of the most recent Fed meeting, and a broader retreat from risk assets generally. That's the backdrop XRP is fighting against, and no amount of Ripple-specific good news fully insulates a token from that kind of macro pressure. Now here's where it gets more specific to XRP, and this is the part I think deserves the most attention right now. The Clarity Act. If you've been in this space for any length of time, you know this bill has basically become the single biggest swing factor for XRP's medium-term trajectory, more than ETF flows, more than Ripple's banking partnerships, more than anything else on the radar. And what's happened over the past couple weeks is genuinely important. The probability of Senate passage, as tracked by prediction markets, has fallen meaningfully from somewhere in the 70s down into the high 40% range. That's not a small move in sentiment. That's the market repricing a piece of legislation it thought was nearly a lock, and now sees as closer to a coin flip. Why did that happen? From what's being reported, there's pushback from law enforcement agencies around a specific section of the bill, and that kind of institutional friction tends to slow legislative momentum in ways that simple political disagreement doesn't. When you combine falling odds on a major regulatory catalyst with a broader risk-off macro environment, you get exactly the kind of sell-off we're watching unfold. This isn't mysterious. This isn't manipulation. This is two genuinely bearish inputs compounding on each other at the same time. But, and this is where I want you to start paying very close attention, falling price and falling sentiment are not the same thing as falling fundamentals. And conflating those two things is, in my opinion, the single biggest mistake retail investors make during drawdowns like this one. Let's talk about what's actually still happening underneath this price action, because it tells a very different story than the candles do. XRP spot ETFs have continued to see net inflows for 7 consecutive weeks. Let that sit for a second. While the price has been falling, actual regulated capital, capital that has to go through compliance, due diligence, allocation committees, has continued to flow in week after week, even as the headlines get uglier. That is not typical retail behavior. Retail tends to chase green candles and panic sell red ones. Institutional capital, when it's behaving rationally, tends to do the opposite. It accumulates into weakness when the long-term thesis hasn't changed, and it pulls back when the thesis itself breaks. The fact that we're seeing sustained inflows through one of the uglier stretches of price action this year is, at minimum, a data point that deserves more attention than it's getting. On top of that, on-chain data has shown a meaningful amount of XRP moving off exchanges, alongside a record number of unique whale wallet addresses. Now, I want to be careful here because I think a lot of channels overstate what this means. Exchange outflows and whale accumulation are not proof of an imminent reversal. They are not a green light to buy. What they actually represent is a behavioral signal. Large, presumably more sophisticated holders choosing to reduce their exposure to centralized exchange risk and consolidate positions during a period of weakness rather than dump into it. That's worth noting. It's not a prediction. It's an observation about who's doing what right now, and it stands in pretty stark contrast to what we're seeing from smaller retail wallets where exchange inflows have been ticking up, typically a sign of profit taking or capitulation selling, depending on which part of the move you're in. So here's the picture I want you to hold in your head as we move into part 2. We have a macro backdrop that has turned hostile, with Bitcoin breaking key levels and liquidations cascading through the system. We have a regulatory catalyst, the Clarity Act, that has gone from looking like a near certainty to looking genuinely uncertain, which has stripped out a lot of the optimism that was baked into price earlier this year. And at the same time, underneath all of that bearish noise, we have continued institutional inflows and whale accumulation that simply doesn't match the panic you'd expect to see if the long-term thesis were actually broken. Those two stories, the surface story and the underlying story, are not pointing in the same direction right now, and that disconnect is exactly what we need to dig into next. Because the question that actually matters here isn't why did the price go down? We just answered that. The question that matters is whether what's happening right now represents a genuine structural shift in XRP's outlook, or whether this is a sentiment-driven overshoot layered on top of a macro-driven flush, the kind of move that historically has set up some of the more important entry points for people who did their homework instead of reacting emotionally. Let's talk about the Clarity Act properly, because I think this is the part of the conversation where most XRP commentary completely falls apart. People throw the name of this bill around like it's a magic password that either gets said and the price goes up, or doesn't get said and the price goes down, without actually understanding what's in it, who's fighting over it, or why the timeline keeps shifting. If you're going to make decisions around this catalyst, you need to understand it at a deeper level than bill good, price go up. At its core, the Clarity Act is an attempt to draw a clear regulatory line between digital assets that function as securities and digital assets that function as something else entirely. A commodity, a payment mechanism, a network token. For years, the core problem in this industry wasn't that regulation didn't exist, it's that nobody could agree on which regulator had jurisdiction and under what definition. That ambiguity is precisely what kept a lot of institutional capital on the sidelines for years, because no compliance department wants to allocate serious money into an asset class where the rules might retroactively change underneath them. So when this bill cleared committee earlier in the year and got formally placed on the Senate calendar, that was a structurally significant event, not just a sentiment one. It meant the bill had cleared one of the genuine procedural bottlenecks that kill most legislation before it ever reaches a floor vote. Now here's where it gets more complicated and where I think a lot of channels are doing their audience a disservice by glossing over the details. Part of what's slowed momentum recently has been pushback from law enforcement adjacent interests around a specific section of the bill. Without getting lost in legislative minutiae, the friction point centers on concerns about how certain provisions might affect the ability of agencies to track, freeze, or pursue illicit transactions once a clearer regulatory carve-out exists for tokens like XRP. This is a legitimate policy tension, not a manufactured one. On one side, you have an industry that has waited years for clarity and just wants a workable framework. On the other side, you have institutions whose job is enforcement, raising concerns about whether that framework creates blind spots. Both sides have a real argument, and when you have that kind of substantive disagreement rather than pure political gridlock, bills tend to take longer to resolve because you can't just whip votes through partisan pressure. You actually have to renegotiate language. This is exactly why we've seen the probability of Senate passage, as tracked by prediction markets, slide from a level where most participants treated it as close to inevitable down into territory that's genuinely a coin flip. I want to sit with that number for a second because I think it's more informative than people realize. A market implied probability dropping that significantly in a short window tells you that informed participants, people actually tracking committee chatter, lobbying activity, and scheduling signals out of Senate leadership, have real fresh information suggesting delay or renegotiation is more likely than it was a few weeks ago. That's not the same as the bill being dead. Bills get renegotiated, sections get rewritten, and revised versions get reintroduced all the time. But it does mean that anyone pricing in a clean, fast floor vote was almost certainly too optimistic, and the market is now correcting for that overconfidence. Here's the part that I think deserves more attention than it's getting, though. Even with the regulatory path getting bumpier, there's still a separate piece of this story that's been quietly running in the background and getting almost no airtime: the European regulatory deadline. The EU's MiCA framework has a transition period that's closing out at the start of July, and the numbers around compliance are honestly staggering. Thousands of crypto firms registered across Europe over the past couple years, and as of a few weeks ago, only a small fraction of them had actually secured a MiCA license. That means a large majority of pre-MiCA platforms are about to lose their registration status almost overnight. Now think about what that actually means in practical terms. Payment volume, remittance corridors, stablecoin settlement activity, all of that has to migrate somewhere once non-compliant platforms get cut off. And Ripple has spent years building out compliance infrastructure specifically so that XRP and RLUSD would be positioned to absorb exactly that kind of migration. This is the kind of catalyst that doesn't show up in a flashy headline or move the price in a single day, but structurally, it matters more for XRP's long-term utility thesis than another 30 cents of short-term price action either way. I want to pause here and make a clear distinction because this is exactly the kind of moment where speculation gets dressed up as fact in this space. It is a fact that the MiCA transition deadline is approaching and that compliance rates among existing platforms have been low. It is a fact that Ripple has positioned itself as an early compliant infrastructure provider in that environment. It is not a fact, it is a reasonable but unproven thesis that this migration will translate into a meaningful, visible increase in XRP transaction volume or price appreciation on any particular timeline. Plenty of structurally sound theses take far longer to show up in price than people expect, and some never fully materialize the way the narrative suggests. I'd rather you understand the mechanism and form your own judgment about how much weight to give it than have me tell you it's a guaranteed pop. Let's bring this back to the Clarity Act timeline specifically, because I think this is where expectation management matters most. Even in the more optimistic scenario where the Senate Banking Committee's version gets successfully merged with the Senate Agriculture Committee's version and leadership schedules an actual floor vote, that is still a process measured in weeks at the very minimum, and realistically could stretch longer if law enforcement concerns require substantive rewrites rather than cosmetic changes. The White House has floated dates tied to symbolic moments like Independence Day for broader crypto legislation, but symbolic deadlines and legislative reality rarely move in lockstep, and I'd encourage you to treat any specific date attached to a bill like this with real skepticism until it's actually scheduled on the floor calendar. People who anchor their trading decisions to a specific date for a piece of legislation are setting themselves up to be disappointed by Washington's actual pace, which is almost always slower than the optimistic case assumes. So where does that leave us heading into the next stretch? I think the honest, balanced read is this. The Clarity Act remains the single most important medium-term catalyst for XRP's regulatory re-rating story, full stop. Nothing about the recent pushback changes that underlying reality. What has changed is the market's confidence in a fast, clean resolution. That recalibration is a meaningful part of why price has come under pressure, separate and apart from the broader Bitcoin-driven macro sell-off we talked about in part 1. If you're trying to trade or invest around this specific catalyst, you need to internalize that the timeline has gotten murkier, not that the destination has changed. There's a real difference between this isn't happening and this is taking longer and requires more negotiation than the optimists assumed. And right now, the evidence points much more toward the latter than the former. Now, here's a question I want you to actually sit with before we move into part 3, because I think it cuts to the heart of how most people in this market actually behave versus how they think they behave. If you genuinely believed a month ago that the Clarity Act passing was the single biggest catalyst for XRP's long-term value, and nothing about the bill's substance or eventual likelihood of passing has fundamentally changed, only the timeline has gotten murkier, why would a 6 to 8 week delay change your actual long-term thesis? That's not a rhetorical jab. It's a real question, because I think the answer reveals whether someone is actually investing based on a multi-year thesis about regulatory clarity and institutional adoption, or whether they were really just trading short-term momentum and calling it conviction. I want to start this part with something that might sound uncomfortable, but I think it needs to be said plainly. A huge amount of the XRP community treats institutional adoption as a buzzword instead of an actual thing they track and verify. People repeat the phrase in comment sections and Discord servers without being able to name a single specific partnership, payment corridor, or banking relationship Ripple has actually built. So before we go any further, I want to separate the narrative from the substance, because the substance here is genuinely more interesting than the narrative, even in the middle of a brutal price chart. Ripple's actual business, the private company, separate from the token itself, has continued building out its payments infrastructure throughout this entire downturn, and that's worth sitting with for a moment. Reports earlier this year pointed to multiple new banking partnerships forming in the cross-border payment space, including a significant deal tied to a Southeast Asian remittance corridor processing billions of dollars annually. Now, I want to be precise about what that actually means, because I think this is where a lot of retail investors get the mechanics wrong. On-demand liquidity, the actual use case Ripple has been pushing for years, doesn't require the price of XRP to go up for the system to function. It requires XRP to be liquid, fast, and cheap to move, so that financial institutions can use it as a bridge asset between currency pairs without holding large pre-funded balances in destination markets. That's a utility thesis, not a pure speculation thesis. Whether that utility actually translates into sustained price appreciation over time is a separate question, and a fair one to keep asking. But the underlying business activity itself doesn't pause just because retail sentiment on Twitter turns negative. This is actually one of the more important distinctions I think people miss entirely during periods like this one. There are two completely separate machines running here. There's XRP, the speculative asset, which trades on sentiment, leverage, macro conditions, and narrative, and which is exactly what we've been describing falling apart over the past few weeks. And then there's Ripple, the company, building payment rails, signing banking deals, expanding RLUSD, stablecoin infrastructure, and positioning itself for compliance-driven migration as frameworks like MiCA come into force. Those two machines are connected, but they don't move in lockstep, and definitely not on the same timeline. Price can suffer for months while the underlying business quietly continues compounding partnerships. And conversely, price can run dramatically ahead of any actual fundamental progress, the way we saw happen multiple times across previous cycles. If you only watch the price chart, you're only getting half the picture, and arguably the more volatile, less informative half. Let's talk about what I think is actually the most underappreciated piece of this entire setup right now, the divergence between whale behavior and retail behavior that we touched on in part 1. I want to go deeper into why this matters, because I don't think simply citing the statistic does it justice. When you see a meaningful, sustained increase in the holdings of wallets in the 1 million to 10 million XRP range, accumulating during a period when price is actively falling, that is not noise. Wallets of that size are not run by casual retail traders refreshing an app between meetings. They represent funds, OTC desks, high net worth individuals, or entities with enough capital and enough conviction to absorb supply during weakness rather than add to the selling pressure. Compare that to what we're seeing on the other end of the spectrum, where wallets holding smaller amounts have been increasing their exchange deposits, which is typically a precursor to selling. This is the textbook definition of capital rotating from weak hands to strong hands during a drawdown, and historically, in this asset specifically, that kind of rotation has tended to precede periods of base building rather than continued collapse. Now I need to immediately add the caveat that responsible analysis requires, because I don't want to overstate what this pattern actually tells us. Whale accumulation during a downtrend is not a timing signal. It does not tell you that the bottom is in today, this week, or even this month. Whales can accumulate for months while price continues grinding lower, and there is no historical law that says accumulation must be immediately followed by a reversal. What this pattern actually tells you is something about conviction and relative positioning, not about timing. It tells you that a meaningful subset of larger, presumably better informed participants are treating this drawdown as an opportunity to increase exposure rather than reduce it. Whether that conviction turns out to be correct is something we'll only know in hindsight, and I'd be doing you a disservice if I dressed up an on-chain pattern as a guaranteed market timing tool. Let's bring ETFs back into this conversation, because I think the inflow data deserves a more rigorous look than just citing the headline number. Spot XRP ETFs have now logged net inflows for 7 consecutive weeks, even as the broader crypto market, including Bitcoin, has experienced significant outflows during parts of that same window. That divergence is genuinely unusual. When Bitcoin ETFs are bleeding money during a risk-off period, and yet XRP-specific products continue attracting fresh capital, that tells you something about who is positioning into this asset right now. This isn't the behavior of investors trying to time a quick bounce. Allocators running ETF mandates typically operate on longer rebalancing horizons, and a 7-week streak through a genuinely ugly stretch of price action suggests a thesis being built around multi-month or multi-year positioning, not an attempt to catch a short-term swing trade. Cumulative inflows since the ETFs launched have now pushed past the $1 billion mark, which, regardless of where price sits today, represents a real durable channel of demand that simply did not exist for this asset a couple years ago. I want to be careful here too, though, because I think it's important to model the bear case honestly rather than just stacking up bullish data points and calling it a day. ETF inflows continuing during a price decline could mean patient capital building a long-term position into weakness. It could also mean that allocators are running systematic, rules-based strategies that don't react quickly to short-term price deterioration, and that if this downtrend extends much further or breaks key psychological levels in a disorderly way, you could eventually see those flows reverse too. We have not seen that reversal yet, but hasn't happened yet is not the same as structurally impossible. And I think any analyst who tells you ETF flows are a permanent, unbreakable floor under price is overselling the certainty of what is, in reality, just a behavioral pattern that has held for several weeks. So let's talk about retail psychology for a moment, because I think this is where most people watching this video are going to recognize themselves, whether they want to admit it or not. The single most common mistake retail investors make during a drawdown like this one isn't holding too long or selling too early in isolation. It's the inconsistency between the thesis they claim to have on the way up and the behavior they exhibit on the way down. People buy XRP talking about multi-year institutional adoption, cross-border payment infrastructure, and regulatory clarity as their reasoning. Then, 6 weeks into a drawdown driven primarily by macro deleveraging and a delayed legislative timeline with absolutely nothing structurally broken about that original thesis, they panic sell at exactly the moment when on-chain data shows larger, more sophisticated participants doing the opposite. That's not a moral failing, by the way. It's a deeply human response to watching your account balance shrink in real time. But it is worth naming clearly, because recognizing that pattern in yourself in real time while it's happening is genuinely one of the more valuable skills you can develop as an investor in this asset class specifically, given how violently XRP tends to swing in both directions. I also don't want to let the bullish framing run away with itself here, because there's a version of this analysis that tips into exactly the kind of blind hype I said at the start I wasn't going to give you. Just because whales are accumulating and ETF flows remain positive does not mean retail sellers are automatically wrong. Sometimes the crowd capitulates because the situation genuinely has deteriorated, and the people holding through it are about to be proven wrong, not vindicated. Markets don't owe contrarians a reward just for being contrarian. The reason I'm framing this divergence as meaningful is because it lines up with a coherent underlying explanation: regulatory delay rather than regulatory failure, macro-driven deleveraging rather than an XRP-specific collapse in fundamentals. But I want to be honest that this interpretation could still be wrong, and price action over the coming weeks is the actual test of which red is correct. Let's zoom out, because I think one of the biggest mistakes you can make right now is analyzing XRP in isolation, as if it exists independently of the broader crypto market cycle it's embedded in. XRP doesn't trade in a vacuum. It trades inside a structure where Bitcoin generally leads, capital rotates outward into altcoins during risk-on phases, and that same capital retreats back into Bitcoin or out of the asset class entirely during risk-off phases. Understanding where we are inside that structure right now is, in my opinion, more important than any single headline about the Clarity Act or any individual whale wallet movement. So where are we? Bitcoin has broken down to its lowest levels in roughly 20 months, with cascading liquidations in the hundreds of millions of dollars and persistent ETF outflows stacking up over multiple consecutive weeks. That is not a healthy, controlled pullback. That is the kind of price action that typically reflects forced selling, deleveraging, and capitulation rather than orderly profit-taking. When Bitcoin behaves this way, altcoins almost universally get hit harder, both because of higher beta and because liquidity tends to evaporate from smaller cap pairs first when market makers pull back risk. XRP losing successive support levels through June, eventually slipping into territory not seen since late 2024, fits squarely within that pattern. This isn't XRP failing some unique test. This is XRP behaving the way it has behaved in essentially every prior period when Bitcoin has gone through a similarly violent deleveraging event. Here's where I want to introduce a concept that I think gets thrown around carelessly in this space: the idea of a macro bottom. People love to call bottoms in real time, usually based on a single indicator or a single piece of news. And most of the time they're simply wrong, because bottoms are processes, not single moments, and they're usually only confirmed well after the fact. What we can do responsibly is look at the conditions that have historically coincided with major XRP bottoms in past cycles and compare them to what we're seeing today, without claiming we know in advance that history will repeat on the same timeline. In prior major drawdowns, XRP bottoms have tended to coincide with a cluster of specific conditions appearing together. Extreme oversold readings on momentum indicators like the RSI, sustained on-chain accumulation by larger wallets even as price continues falling, capitulation-style selling from smaller retail holders, and eventually some kind of external catalyst, either regulatory or macro, that shifts sentiment. Right now we can check off some of these boxes. RSI readings across multiple timeframes have pushed into oversold territory. Whale accumulation, as we discussed in Part 3, has been ongoing. Retail exchange deposits have been ticking up, consistent with capitulation-adjacent behavior. What we have not yet seen is a clear external catalyst confirming a shift, because the Clarity Act, the most obvious candidate for that role, is currently sitting in a more uncertain position than it was a few weeks ago, and the macro backdrop, dictated largely by Federal Reserve policy and broader risk appetite, hasn't turned supportive yet either. I want to be very explicit about what this means and what it doesn't mean. It means that several of the ingredients historically associated with bottoming processes are present. It does not mean we are at, near, or past the bottom. Markets can stay oversold for extended periods, especially when macro conditions remain genuinely hostile, and an asset can keep making new lows even while on-chain accumulation continues, simply because the marginal seller at any given moment, often a leveraged trader getting liquidated or a retail holder capitulating, doesn't care what whales are doing 3 steps ahead of them. If you take nothing else from this section, take this. Oversold conditions and accumulation patterns describe probability and behavior. They do not describe certainty or timing, and treating them as a green light to aggressively buy without respecting that the trend remains down is how people get hurt in exactly this kind of market. Let's talk about Bitcoin's influence specifically, because I think this deserves more nuance than Bitcoin goes down, XRP goes down. Historically, in the later stages of a broader crypto cycle, you tend to see one of 2 patterns play out with assets like XRP. Either XRP continues to trade as a high beta extension of Bitcoin, amplifying moves in both directions without much independent narrative strength, or XRP begins to decouple, where Ripple-specific catalysts, regulatory clarity, banking partnerships, ETF flows start to outweigh pure Bitcoin correlation. We've actually seen flashes of that decoupling behavior earlier this year, where XRP responded more to Ripple-specific news than to broader market sentiment during certain stretches. The fact that we've reverted back to a more correlated Bitcoin-driven pattern during this particular sell-off tells you something important. Decoupling is conditional, not permanent. It tends to hold during calm periods when there's a clear, positive Ripple-specific catalyst dominating the news cycle, and it tends to break down during genuine macro stress events when fear becomes the dominant emotion across the entire asset class and idiosyncratic stories get drowned out. That's a pattern worth remembering, because it tells you that XRP's much discussed independence from Bitcoin is real but fragile and shouldn't be relied upon as a hedge during exactly the kind of environment we're in right now. Now I want to address something directly, because I think it's the elephant in the room for anyone who's been holding XRP through this entire stretch. The psychological toll of watching an asset you believe in get dragged down by forces that have nothing to do with its actual fundamentals. There's a particular kind of frustration that comes from watching whale wallets accumulate, watching ETF inflows continue, watching genuine regulatory and business progress happen, and still watching the price chart bleed lower because Bitcoin is having a liquidation event or because a Senate committee can't agree on enforcement language. That frustration is valid. It's also, I'd argue, exactly the wrong emotion to make decisions from, because it tempts people into either panic selling out of exhaustion or, on the opposite end, into reckless leverage in an attempt to make it back faster, both of which tend to produce worse outcomes than simply sitting with a clearly defined thesis and reevaluating it on a longer time frame than the daily candle. Let's also be fair to the bear case here, because a balanced analysis requires it, and I don't think enough channels are willing to actually sit in this discomfort. There is a real scenario where this isn't a healthy shakeout at all, where it's the beginning of something more structurally damaging. If the Clarity Act stalls out entirely rather than simply getting delayed, if law enforcement concerns prove difficult to resolve through compromise language, if the broader macro environment continues deteriorating with the Federal Reserve maintaining a hawkish stance for longer than markets currently expect, you could see a scenario where XRP loses the psychological $1 level decisively and spends an extended period testing levels well below where most current holders are positioned. On-chain volume profile data has actually flagged a thinner trading zone beneath current levels, meaning that if key support breaks, price could move through that region more quickly than people expect, simply because there's historically been less trading activity and therefore less natural buying interest in that range. I'm not saying that's the most likely outcome. Based on the data we've walked through, I'd actually lean toward viewing this as closer to a macro-driven flush than a fundamental collapse. But more likely is not the same as guaranteed, and anyone telling you with full confidence that XRP cannot break meaningfully lower from here is giving you a prediction dressed up as certainty, which is exactly the kind of overconfident framing I'm trying to steer you away from throughout this entire video. Let's bring everything together, because I think the value of this entire analysis comes from synthesis, not from any single data point we've covered. Over the last 4 parts, we've walked through a lot of ground, and I want to organize it clearly so you can actually use it, rather than just walking away with a vague feeling of either fear or excitement, which is honestly what most crypto content leaves people with. Here's the bear case. Stated as plainly and fairly as I can state it. XRP has broken down through multiple key support levels over the course of June, falling into territory not seen since late 2024, driven by a combination of broader macro deleveraging tied to Bitcoin's collapse to a 20-month low and a meaningful repricing of Clarity Act passage odds, which slid from a level the market treated as close to certain down into genuine coin flip territory amid law enforcement pushback on specific provisions. The technical structure remains bearish across multiple timeframes. Price sits below short, medium, and longer-term moving averages, and there's a thinner volume profile below current levels that could allow for a faster move lower if key psychological support breaks decisively. If the Federal Reserve maintains a hawkish stance longer than markets currently expect, and if the Clarity Act negotiations drag on or stall entirely rather than simply getting delayed, there is a real, legitimate path toward XRP testing significantly lower levels before any of the positive catalysts we've discussed have a chance to actually play out. That is not fear-mongering. That is simply respecting what the chart and the macro backdrop are currently telling us. And anyone who tells you that path is impossible is not being honest with you. Here's the bullish case, stated with the same level of rigor. Underneath the price weakness, we have 7 consecutive weeks of net inflows into spot XRP ETFs, a streak that has continued even through periods when Bitcoin ETFs were seeing outflows, suggesting a base of patient, longer horizon institutional capital that has not been shaken by the recent drawdown. We have sustained accumulation from large wallets, increasing their holdings specifically during the period when price has been falling, which historically reflects a meaningful divergence from typical retail behavior during capitulation phases. We have a regulatory thesis, the Clarity Act, that has not failed, but has simply hit a renegotiation period, which is a normal part of how substantive legislation moves through the Senate, especially when genuine policy disagreements rather than pure partisan gridlock are involved. And we have a structural business-level catalyst running almost entirely under the radar right now, the EU's MiCA compliance deadline, which is set to push a large share of non-compliant platforms out of the market in the coming days, creating a real opportunity for Ripple's already compliant infrastructure to absorb migrating payment volume over the medium term. None of that requires hype. It requires patience and a willingness to separate Ripple's underlying business progress from XRP's short-term price behavior, which we talked through in detail back in part 3. So what's the honest, balanced takeaway? I think it's this. The sell-off we've experienced is real, it's painful, and it's been driven primarily by forces larger than XRP itself. A Bitcoin-led macro deleveraging event combined with a genuine, if probably temporary, setback in regulatory catalyst timing. That combination is more than enough to explain the price action we've seen without needing to invent some XRP-specific failure that doesn't actually show up anywhere in the on-chain or institutional flow data. At the same time, several of the conditions that have historically preceded meaningful bottoms in this asset, oversold technical readings, sustained whale accumulation, and retail capitulation, are visibly present right now. What's missing is the confirmation piece, a clear positive catalyst actually landing, whether that's the Clarity Act clearing a Senate floor vote, a meaningful shift in Federal Reserve tone, or Bitcoin itself stabilizing and reclaiming key levels. Until one of those confirmation events actually happens, calling this the bottom is a forecast, not a fact, and I'd encourage you to treat it exactly that way in your own decision-making. I also want to leave you with a word on process because I think it matters more than any specific price target I could give you. The biggest determinant of how this period turns out for any individual holder isn't going to be whether they correctly predicted the exact bottom. It's going to be whether their actual behavior matched the thesis they claimed to hold when they first got involved with this asset. If your reason for holding XRP was built around multi-year regulatory clarity, institutional adoption, and cross-border payment infrastructure, then a few weeks of legislative delay and a macro-driven liquidation event don't actually invalidate that thesis, they just test your patience against it. If, on the other hand, your reason for holding was really just short-term price momentum dressed up in fundamental language, then this is exactly the kind of environment that reveals that distinction, often at the worst possible time emotionally. Knowing honestly which category you fall into is, in my opinion, more valuable than any indicator we've discussed in this entire video. To summarize the key takeaways clearly, XRP's recent decline has been driven primarily by Bitcoin-led macro deleveraging and a repricing of Clarity Act passage probability, not by any specific deterioration in Ripple's underlying business activity. Institutional flows into XRP ETFs and large wallet accumulation have continued through the downturn, creating a notable divergence from retail behavior, though this divergence is a behavioral signal, not a timing tool. The Clarity Act remains delayed and uncertain rather than dead, with the actual substance of the disagreement centered on legitimate law enforcement concerns, rather than simple political opposition. A separate, underappreciated catalyst, the EU's MiCA compliance deadline, is approaching and could meaningfully benefit Ripple's already compliant infrastructure over the medium term, independent of how the US legislative timeline unfolds. And finally, several conditions historically associated with major bottoms are present in the current data, but the absence of a confirmed positive catalyst means this should be treated as a developing situation rather than a confirmed turning point. The realistic range of outcomes from here genuinely includes both a continuation lower if macro conditions stay hostile, and regulatory progress stalls further, and a meaningful base building process if even one of the pending catalysts resolves positively in the coming weeks. Anyone presenting only one of those outcomes as certain isn't giving you the full picture. This content is for educational and entertainment purposes only and should not be considered financial advice. Always do your own research before making any investment decisions. Cryptocurrency markets are highly volatile and all investments involve risk.